If you are looking for a unique indicator to produce signals for your strategy or to add as a filter for your strategy, then you are in the right place. In this video, I will show you an obscure indicator. In fact, I looked over the internet for the code. I couldn't find it, so I had to build the indicator myself. The indicator is called Range Expansion Index by Thomas DeMark. Thomas DeMark introduced many indicators, and he described the Range Expansion Index in a couple of his books. And Thomas' argument for this indicator is most indicators use the close as part of their calculations. And the argument is by using the close only, you are not paying attention to the intraday movement of that bar. So Thomas DeMark indicator actually doesn't use the close. It uses the high and low of the intraday bar to come up with the oscillator. So I built this oscillator in PowerLanguage, and I'll show you how it looks like. And this is the oscillator. So basically it goes from minus 100 to 100, and it has a look back period, and you can have two levels just like CCI, for example. But because it uses the high and low of the intraday bar, the oscillator is kinda unique in its looks and in its signals. So this is a comparison. For example, on the same chart, the right side is the RSI 2 and the left side is the REI, which is the Range Expansion Index, using 2 period. And as you can clearly detect that the signals are totally different from the RSI 2. Now, of course, you have to understand that indicators are not the main part of any strategy. First of all, you have to come up with an edge and then build a strategy around that edge. So for example, if the edge is long, then I am going to look for an indicator that produced long signals. So for an oscillator, I could wait for a pullback, or I could wait for a breakout. And so the indicator is already doing something that I already know, which is to go long in this case. And if my edge is to go short, then I can use the same indicator, but now I will wait for the oscillator to go high in order to short, or when it's going low, then I can take a breakout on the short side. So the reason I look for different indicators is because I can come up with a strategy based on the same edge, but it produces a different equity curve. So for example, if the RSI 2 strategy on the S&P 500 is to go long using mean reversion style, and let's say that strategy produces a loss in 2020, then this indicator using the same edge, which is to go long on the S&P 500 using mean reversion style, but then this indicator will not produce a loss in 2020. And that's the advantage of other unique indicators. So here is a strategy built around the REI indicator. I'm using here the S&P 500 E-mini futures since 2007. So we can test the indicator using an optimization. And here is the length, which is the look back of the indicator, and then the overbought level and the oversold level. So the strategy will go long when the oscillator goes below the oversold level, and it will exit when the oscillator goes above the overbought level. So using these combinations, we will get about 8,800 strategies. So here is a 3D chart of the optimization values. So this is the oversold value. When the price goes below this number, we go long. And when it is above this number, we exit. And these are the look back values. So you see when I change them, the graph changes. And you notice something immediately apparent, which is this corner is always profitable. Now, mind you, all of them are profitable. I mean, the blue line, let's set it to 100. So currently this blue line is 100. And you can see everywhere I click on all lookbacks, this area is profitable. Now, since I want more trades, so I need to pick maybe between 2 and 8. So this is sorted by the length, and you see number 2 is the first one, and all the values are great. Now, if I scroll down, you can see that the number of trades goes down the higher the look back period, which is expected. So again, I will stick with number 2. So now I will fix this as number 2 and then redo the optimization. And now we have only 441 combinations. And now if I sort by return to drawdown, this is the best combination. So the look back is fixed at 2, and this is the oversold value. So when the oscillator below 10, we go long. When it's above 25, we exit. And the top 4, they are all 10. So we have 10.25, 10.15, 10.20, and 10.30. And they are all very close in performance. Also, 10.25 is between 10.20 and 10.30. 10.35 is still very close in performance, and 10.40. So they are all very close in performance. So let's pick 10.30. And this is something, not the peak. And this is our strategy now. So now I set the indicator to look like the strategy. So basically, when the indicator goes below the green line, we buy. When it goes above the red line, we exit. So here is an example. The oscillator goes below the green line here, we buy next bar, and it goes above the red line here. So next bar, we exit. Same thing. Oscillator goes below green line, next bar we buy, and then here the oscillator goes above the red line, so next bar we exit. And just like you saw in the example, all mean reversion strategies have a drawback, which is they might stay in a trade for a long time, and you can mitigate this with a stop loss, and I prefer to exit after number of bars. And just to keep the strategy pure and clean, I will use 15 bars so as not to affect the performance of the strategy. Because of course, the shorter the number of bars, that will have a big effect on the strategy, which there is nothing wrong with that. But here we are not building like a strategy, we're just showing the concept. So this is the strategy performance. And now I will add the exit after 15 bars. So the difference is minimal, and we only increase the number of trades by 4. So we have a stop loss that doesn't kick in unless we are in extreme conditions. This is the equity curve of the strategy, and here is the trade analysis, 560 trades, 65% win rate, 360 on average, and this is the periodical returns. So the test from 2006 up to end of April 2025. Now, of course, we can enhance this with a filter, and I used the volume oscillator before, and I will use it here again. So let's add the filter, and this filter reduces the number of trades a lot, or I would say 40%. Also, we reduce our profits, but we increase our return to drawdown to almost double. If we go to the trade analysis, we can see now our average trade jumps to 530. And our win rate jumps to almost 69. And now here is the annual period analysis. Now, of course, this is one filter, but you can add any other type of filter. Volatility, direction usually works really well. But like I mentioned before, the main purpose of introducing a new indicator on the same edge, the same market, is to produce a different equity curve. So here is a comparison between the classic RSI 2 strategy and the REI oscillator. And we see, of course, both curves are going up on the S&P 500, which is what we want, but they are not exactly the same in terms of the drawdowns. And here is a portfolio of the two strategies on the same market. So as you can see here, this is the RSI default, and this is the REI 21030 with the filter. And if we run the correlation, we can see that we are only 0.36 correlated. And both markets are producing around the same number of trades with around the same amount of net profit. And that is exactly what we are looking for in another indicator, which is just to produce a different equity curve using the same strategy, same style on the same market. Of course, you can use the oscillator as a filter for other strategies, or to produce other signals for breakout or for mean reversion on the short side. If you like this video, then you will love the next one.